If you operate an S corporation, somebody probably told you to keep your salary low to save on payroll taxes. Now, that advice isn't wrong, but it's incomplete in a way that can cost you money on both ends. There's a salary that's too low that gets you audited, and there's a salary that's too high and quietly destroys the tax savings the S Corp was supposed to create. And reasonable compensation isn't a number someone looks up. It's a documented determination that most S corporations have never actually made. I'm Bill Bourbonnais, and thanks for joining us for this week's Three Things Thursday. Today, three things every S Corp owner needs to know about their own salary. Thing number one, the trap runs both ways. Most of the attention goes to owners who pay themselves nothing or close to it while pulling everything as distributions. That's the well-documented audit target. The IRS has been winning these cases since Revenue Ruling 74-44 established the authority for the IRS to reclassify distributions as wages when they're paid instead of reasonable compensation. Watson versus Commissioner in 2012 confirmed it at the appellate court level. A $24,000 salary while taking several $100,000 in distributions is not defensible. The IRS wins. The taxes, the penalties, and the interest follow. But the other direction is less discussed and equally real. If your S corporation salary is higher than it needs to be, you're paying more FICA than the law requires. And salary directly reduces the income eligible for the qualified business income deduction. Your K-1 pass-through is the QBI base, not your total income from the business. A salary that's too high shrinks what's sheltered from FICA and what's eligible for that potential 20% deduction at the same time. The target isn't the lowest possible number. It's the correct number, documented, defensible, and calibrated to your actual role in the business. So, too low is an audit target. Too high costs you in FICA and QBI. The goal is the right number, and most S corporation owners have never calculated it. Thing number two, reasonable is a multi-factor test, not a number you pick. IRS Fact Sheet 2008-25 lays out 9 factors that courts have considered when there's a dispute over compensation. This is the IRS's own playbook. Training and experience, duties and responsibilities, time and effort devoted to the business, distribution history, the ratio of what you take as distributions versus salary, what you pay non-shareholder employees doing comparable work, how and when your bonuses are paid, what comparable businesses in your industry pay for similar services, compensation agreements, and whether a formula was used to determine the amount. The comparability factors matter in both directions. If you're paying a non-owner employee more than yourself for similar work, that's an automatic red flag on the low side. If your salary significantly exceeds that role that it commands in the market, you're overpaying on FICA and eroding your QBI deduction unnecessarily. The IRS Statistics of Income Division publishes aggregate data on officer compensation ratios for S corporations by industry. They know what businesses like yours pay their officers in aggregate. Your number needs to live in a defensible range, and it needs to be documented. A compensation analysis, corporate minutes establishing the salary and when it takes effect, annual review as the business changes. I picked a number that felt right is not a defense in an IRS examination. The burden is on the corporation to establish that the amount is reasonable. 9 factors, IRS industry data, a documented analysis, and corporate minutes to support it. Not a percentage someone read on the internet. Thing number 3, the C Corp mirror. This one is for C corporation owners, and it runs exactly opposite to the S Corp problem. In a C corporation, officer salary is deductible at the corporate level as an ordinary and necessary business expense. Distributions of profit, dividends, are not. They're paid from after-tax corporate profit and then taxed again on the owner's personal tax return. That's the double tax you hear about with corporations. So a C corporation owner has a natural incentive to pull money out as salary rather than as dividends. Salary is deductible and not subject to double tax. Dividends aren't deductible. Pay yourself more, leave less in the corporation to get taxed twice. The IRS knows this. If a C corporation owner is using an unreasonably high salary to drain profit that would otherwise sit in the corporation and be subject to corporate level tax, the IRS can recharacterize the excess salary as a constructive dividend. They strip the corporate deduction, and then the double tax applies anyway. The test is identical. Reasonable compensation for services actually rendered. The same 9 factors, the same documentation requirement, the same IRS, it's just pointed the other direction. So S corporation, salary too low, employment tax exposure. C corporation, salary too high, constructive dividend risk. Same test, same IRS, opposite direction of abuse, opposite remedy. The reasonable compensation standard is the same. So in closing, your salary as an S Corp owner is not an afterthought or a plugged figure. It's a documented, defensible determination that affects your payroll tax, your TBI deduction, your audit exposure, and if you also operate as a C corporation or operate as a C corporation instead, your dividend tax risk. If you don't have a compensation analysis in your corporate records, that's the gap. Not the salary itself, the documentation behind it. Now, if distinctions like this are helpful, 3 Things Thursday drops every Thursday. Hit subscribe or follow so you don't miss the next one. And if any of this applies to your situation, that's a conversation worth having. Find us at bourbonnetax.com. I'm Bill Bourbonnais. 3 Things Thursday, again, it's for general educational purposes and isn't specific tax advice for your situation. Contact us to learn more about how we work. No hype, no shortcuts, just strategy. We'll see you next week. Have a great day.